Let's talk about Turkey, a unique country that located at both continent of Asia and Europe. The Balkan Turkey, or East Thrace, is a smaller section of the country and located in southeastern Europe, while the Asian part of Turkey, known as the Anatolian Plateau, is a large peninsula that covers the majority of the country and located in southwestern Asia. With its unique location between the European and Asian continents, Turkey has benefited greatly and become one of the main links in the trade routes between Asia and Europe. However, in recent years, Turkey finds itself grappling with a severe economic crisis. The Turkish lira has plummeted in value, reaching historic lows against the US dollar. Turkey inflation has soared, eroding the purchasing power of Turkish citizens. This economic turmoil is deeply intertwined with political decisions and the unorthodox economic policies of President Recep Tayyip Erdogan. Turkey's economy has historically been characterized by periods of robust growth, interspersed with bouts of sharp downturns. This pattern of boom and bust has created an environment of uncertainty for investors and businesses alike. In the early 2000s, Turkey embarked on a path of economic reform and liberalization. These efforts led to a period of sustained economic expansion, with GDP growth rates exceeding those of many developed nations. However, this period of prosperity was not without its vulnerabilities. Turkey's economy became increasingly reliant on foreign capital inflows to finance its growth. This reliance on external funding made the country susceptible to shifts in global investor sentiment. When the global financial crisis hit in 2008, Turkey's economy was significantly impacted. While Turkey managed to weather the initial storm of the global financial crisis, the experience highlighted the underlying fragility of its economy. The country's dependence on foreign capital and its vulnerability to external shocks would continue to pose challenges in the years to come. The Turkish lira, once a symbol of the country's economic progress, has experienced a dramatic decline in value. In recent years, the lira has lost a significant portion of its value against major international currencies, most notably the US dollar. Throughout much of 2022, negative real interest rates had generated a flight away from the Turkish lira, resulting in rapid depreciation of the currency. This currency depreciation has had far-reaching consequences for the Turkish economy. Given the high level of imported inputs in production, the loss in the value of the Turkish lira meant increased production costs, which were quickly passed on to prices. Inflation spiraled out of control and by August 2022 hit 80%. The lira's troubles can be attributed to a confluence of factors, both domestic and external. On the domestic front, President Erdogan's unorthodox economic policies, particularly his insistence on lower interest rates in the face of rising inflation, have eroded investor confidence and put downward pressure on the currency. Externally, factors like the strengthening US dollar, geopolitical uncertainties in the region, and the global economic slowdown have also contributed to the lira's decline. The combination of these internal and external pressures has created a perfect storm for the Turkish currency. President Recep Tayyip Erdogan has long espoused unorthodox economic views. He has repeatedly expressed his belief that high interest rates are the cause of inflation, a view that runs counter to conventional economic thinking. Erdogan's economic policies have centered around promoting economic growth through lower interest rates, even in the face of rising inflation. He has argued that lower borrowing costs would stimulate investment and consumption, thereby boosting economic activity. However, this approach has drawn criticism from economists who argue that it ignores the fundamental relationship between interest rates, inflation, and currency values. Lowering interest rates when inflation is already high can further fuel price increases and devalue the currency. Erdogan's influence over the Turkish central bank has allowed him to exert significant control over monetary policy. He has repeatedly called for interest rate cuts, and when central bank governors have resisted his pressure, they have been swiftly replaced. In March 2021, President Erdogan dismissed Naci Ağbal from his position as governor of the Turkish Central Bank. Ağbal, a respected economist, had been appointed just 4 months earlier and had taken steps to raise interest rates in an effort to combat rising inflation. Ağbal's dismissal sent shockwaves through the Turkish economy and international markets. It was widely seen as a sign that President Erdogan was prioritizing his unorthodox economic views over the independence of the central bank and the need for sound monetary policy. The lira plummeted to record lows in the wake of Akbal's ouster. Investors interpreted the move as a sign that Erdogan was determined to pursue his low-interest rate policy, regardless of the potential consequences for inflation and currency stability. Akbal's dismissal marked a turning point in Turkey's economic crisis. It solidified the perception that the central bank was no longer an independent institution and that monetary policy was being dictated by political considerations rather than economic fundamentals. The dismissal of Nazi Akbal and the subsequent continuation of President Erdogan's unorthodox economic policies had a domino effect on the Turkish economy. With interest rates kept artificially low despite surging inflation, the lira continued its downward spiral. As the lira depreciated, the cost of imported goods, particularly essential items like food and fuel, skyrocketed. This imported inflation further fueled the already high rate of price increases within Turkey, creating a vicious cycle of currency depreciation and inflation. The erosion of purchasing power due to inflation and the rising cost of living placed significant strain on Turkish households. Businesses also faced challenges as the cost of imported inputs increased, squeezing their profit margins and making it difficult to plan for the future. The combination of high inflation, currency depreciation, and declining investor confidence created a toxic mix for the Turkish economy, pushing it further into crisis territory. While Turkey's current inflationary woes are largely attributed to its domestic policies, it's important to acknowledge that inflation is a global challenge. Globally, factors like supply chain disruptions caused by the COVID-19 pandemic, increased energy prices driven by geopolitical tensions, and strong consumer demand fueled by government stimulus measures have all contributed to rising inflation rates. Central banks around the world have responded to this global inflationary pressure by raising interest rates. Higher interest rates make borrowing more expensive, which can help to cool down economic activity and curb demand-pull inflation. However, Turkey, under President Erdogan's guidance, has resisted this conventional approach, keeping interest rates low despite soaring inflation. This divergence from global monetary policy norms has further exacerbated Turkey's economic challenges. During Recep Tayyip Erdogan's first 15 years at the helm of the country, Turkey recorded impressive economic growth and FDI. However, since a failed coup attempt in 2016, a major constitutional change in 2017, and the beginning of unconventional economics starting in 2018, the country's fortunes began to change. Turkey's economy began to suffer. Since 2016, foreign direct investment or FDI into the country has been on a downward trajectory. In 2022, the FDI numbers were $13.7 billion, while in 2023, the numbers declining into $10.6 billion. A decline in FDI value is a sign that the Turkish economy was moving into worse direction. The economic crisis in Turkey has had a profound impact on businesses and households alike, thanks to Erdogan's unusual economic policy. High inflation, currency depreciation, and declining investor confidence have created uncertainty and hardship. Businesses face rising costs and economic instability. Households struggle with eroded purchasing power and rising living costs. Turkey's economic crisis has not unfolded in isolation. It has raised concerns among international investors, policymakers, and neighboring countries. The spillover effects of Turkey's economic woes could have the potential to impact regional and global stability. One of the main concerns is the potential for contagion, the risk that Turkey's economic problems could spread to other emerging markets. This concern is particularly acute for countries that share similar economic vulnerabilities with Turkey, such as high levels of foreign currency-denominated debt and dependence on foreign capital inflows. The crisis has also raised questions about Turkey's ability to meet its financial obligations. As the lira has depreciated, the cost of servicing its foreign currency-denominated debt has increased, raising concerns about a potential sovereign debt crisis. The International Monetary Fund, IMF, has urged the Turkish government to adopt more orthodox economic policies, including allowing the central bank to raise interest rates to combat inflation. The crisis in Turkey's economy is not just caused by a single factor, it's a combination of multi-factors in the past. The policies of Erdogan's government have led to significant economic instability. Turkey also had a heavy reliance on imported goods, makes it vulnerable to global market changes. And then there's the pandemic, which magnified existing issues. These combined factors have plunged Turkey into an economic crisis, and lira values became depreciated so badly. We will see what might come next for Turkey. Until that time comes, stay sharp and stay tuned to the story of finance for more insight on economy. Thanks for watching.